In this video, we are going to cover option types and important terminologies. Here are some of the options trading basics. An option is a contract between two market participants that gives the option holder the right, but not the obligation, to buy or sell a specified number of shares at a fixed price up to the option expiration date. There are two types of options, a call option and a put option. A call option gives the owner the right to buy a specified number of shares of the underlying stock at the strike price up to the set expiration date. A put option gives the owner the right to sell a specified number of shares of the underlying stock at the strike price up to the set expiration date. A typical option quote will contain the following elements. To understand and trade options, you'll need to familiarize yourself with some general terminology. Assigning is the act of the seller fulfilling the obligation of the option contract when the buyer of the option exercises their right. The seller of a call option will need to deliver shares of the underlying stock to the buyer at the strike price, while the seller of the put option will need to purchase shares of the underlying stock from the buyer at the strike price. At the money is when the option strike price is identical to the current trading price of the underlying stock. In the money is when the option contract has a positive value if exercised. In call option, the stock price is above the strike price, and in put option, the stock price is below the strike price. Out of the money is when the option contract has no intrinsic value. In call option, the stock price is below the strike price, and in put option, the stock price is above the strike price. Intrinsic value is the difference between the current market value of the underlying stock and the strike price of an option. In the money is the term used when the intrinsic value is positive. Extrinsic value is the difference between an option's market price and its intrinsic value. Strike refers to the price at which the owner of an option can purchase or sell the underlying security. Long is a term that refers to ownership of securities. For example, if you are long 100 shares of XYZ, this means that you own 100 shares of XYZ company. Short is the act of selling a stock or option you don't own. This is a speculative practice done when the seller believes that a stock price is going to fall and the seller will be able to cover the sale by buying the security back at a lower price. The profit is the difference between the initial selling price and the subsequent purchase price. Option premium. To buy an option contract, you must pay a premium to the seller. Conversely, when you sell an option contract, you receive a premium from the buyer. To stay up to date with our latest videos on stock and options trading, make sure to subscribe to our YouTube channel.